Hello, I'm your host, Mike Gelb, and this is the Consumer VC, where we discuss the intersection of venture capital and consumer innovation. The show is brought to you by Propeller Industries, the leading strategic finance and accounting partner for venture stage companies. If you're enjoying this show, please subscribe on YouTube or whichever platform that you're listening on. And if you want the full experience, subscribe to my newsletter at theconsumervc.com, where you'll get fundraising updates of all the latest in consumer brands and consumer technology, and a recap of all the consumer deals that are happening. All content and episodes are for informational and entertainment purposes only. It is not investment advice. Our guest today is Daniel Faierman, who is partner at Habitat Partners. Habitat Partners is an early stage venture fund that is part of Red Antler. Red Antler is one of the premier branding and marketing agencies. We focus this conversation on Habitat Partners' investment strategy and why it's, I think, pretty unique. They invest in both consumer brands and they invest in software companies, which, as we've kind of talked about a lot on the show, how investing in consumer brands and investing in software, it's actually quite different from a return profile perspective. So we talk about why it makes sense for them to have two different strategies, investing in brands and investing in software. We also talk about the relationship between Habitat Partners and Red Antler, and also how he thinks overall about returns. Without further ado, here's Daniel. Daniel, thanks for joining me so much today. How you doing?
I'm great. How are you? Very excited to be with you here. Have been listening to your podcast since my early days in venture, and it's fun to be on the other side.
That is so kind of you. Also a fan of your podcast, and as well as big fan of you on your content on LinkedIn. So this is such a pleasure to have you on the show. Really looking forward to this conversation.
Likewise.
So I want to start a little bit from the beginning of your career. It was largely around food and beverage. Was that always the plan? Was it always a plan to head into food and bev, that you're so passionate about food
Yeah.
and bev? Was that always kind of the idea? And when you first looked, when you said, "Oh, I actually need to have a career."
Yeah. I mean, I feel like most 18-year-olds like want to think they know what they're doing with their career at 18, but like none of them actually do. And I probably was no exception. Like I was a tennis player in college. I got recruited to Yale to play tennis. And as a Division 1 athlete, I got really passionate about health and wellness and what I was consuming and putting in and on my body. And, I was kind of trying all these different products and seeing like what went well for me performance wise and what I kind of didn't like or rejected. And yeah, I just became pretty fascinated like by the food and beverage system through that kind of experience and obsession with wellness. Not to say that each of the CPG enterprises that I worked at were like wholeheartedly focused on wellness portfolio building always. But nonetheless, it sparked my general passion for like food and beverage and consumer products. And so, like coming out of undergrad, it was exciting for me to join like a big CPG conglomerate and get just like a lot of cross functional training and skill sets within the general like consumer brand ecosystem. So that was kind of the catalyst that got me interested in the first place.
So I know what your first exposure to food and bev out of graduating, you were working at PepsiCo and AB and Bev, some of the largest consumer brands and conglomerates globally. But why? What is stopping? I know that your passion was for health and wellness, and so I'd imagine that may be the reason why you made that transition, that you wanted to go more in focus on that, whether it's venture capital or even maybe as an operator. But why? I'm just from your standpoint, working at big CPG, why is it so hard? What is stopping like innovation coming internally?
Yeah, well, I hope they don't get too good at innovating and then they don't want to buy, startups. But it's interesting you ask because I started my career in a pretty pure finance role, like PepsiCo, Global Finance. They just bought Kavita. But eventually I ended up in innovation at AB InBev. So like I was in the thick of like trying to innovate internally. Like I was literally on the global innovation team. So I saw firsthand like what was working and what wasn't working. Look, I think overall, I think big company innovation gets a little bit of a harder time than like they deserve. For example, like, I was reading a Wall Street Journal article this past weekend that I'm going to post some content on tomorrow. And it was talking about the rise of the Nerds franchise, like the candy, given it's Halloween time. And it was amazing. Like, Ferrero took this Nerds franchise from 5 million to 500 million with like one innovation, this gummy cluster. And it was just remarkable. I was like unbelievable execution to take like one product from 5 million to 500 million in 4 years. Like it just shows like the kind of firepower these big CPGs do have when they find something with product market fit and execute. So like first and foremost, like I wouldn't say that they're terrible innovators. The reason why most of them fail, and there's a fundamental challenge that a lot of people like to talk about, is just for two reasons. Like one, when you go into these big CPG businesses, these enterprises, your goal is to get promoted, right? Like when I was at AB InBev, I started in kind of like global brand strategy. I was working on Corona, Bud, Michelob Ultra, et cetera, on these like strategic projects within like the broader brand organization. My goal was to get promoted to the next level and like get a bigger bonus and get more stock in the business. And then like my goal after getting to the innovation team was to get to like the senior director level. So the problem is you're incentivized to continue climbing up the ladder and taking on new roles as a means of eventually reaching the senior leadership level. And so if you're responsible for like innovation for a specific brand or like target sector, you're probably only be working in that role for like 1 to 2 years. And so what starts to happen is like even if you have a great idea that starts off well, like you're eventually going to be replaced by someone as you move to a new role, and then you have to like juggle the baton to someone else. If you think about like a startup, right? Like someone who builds a business that's successful and exits and scales, like they're usually building that as like the CEO for 5 to 10 years. They have every relationship, through the experience that they've had with the business. So like, if you could imagine like me launching a food product, having all the relationship with the retailers, and it's going really well, and then a year and a half later I get replaced, and then a year and a half later that person gets replaced. Like that is what's happening within CPG enterprise. So that's number one. It's like a talent issue in terms of like employee turnover into new roles. And then the second thing is just like if you think about AB InBev as an example, I think they do what like 60 billion in revenue, about maybe more or less. Um, in order to move the needle, right, for like shareholders, an innovation needs to probably generate, I don't know, at least $1 billion, right? Like, want it to be at least like 1% or more of like the overall revenue of the business to actually move the needle in earnings. And so like that just drives like behavior that really like entails urgency and not like a real like, commitment to patience. And so in general, like we would sit in innovation meetings and like love my CMO to death, but he'd be like, all right, like, what do you guys want to go launch this year? Like, what does the calendar look like? And he'd be like, is that going to be at 500 million in revenue in 3 years? Is that going to be like, so I think just like the level of patience combined with the talent switchover and then like the bureaucracy of getting things into market, makes it challenging. But once they are in market and they're working, the ability to accelerate scale with like points of distribution, relationship with retailers, and then like even further line extensions if it's like a new brand launch is extremely advantageous. And like I think they're the most important partners like in our ecosystem, because if you think about like my passion for health and wellness and how I'm investing in often better for you positioned products, like they're the partners that are ultimately going to take it to the next level of scale. So I think they're a huge part of the ecosystem. They return capital to our fund after an M&A deal, which allows us to reinvest into more businesses, assuming that propels our LPs to double down on us in the future.
Is M&A to a strategic the ideal scenario from an venture investor in consumer brands?
I think so, because the IPO market has been so crappy for a lot of like consumer brands that have tried to tap it, and it's just been inconsistent. Like there's definitely exceptions, but for the most part, like over the last few years, we haven't seen like explosive performing consumer IPOs. And so like what you're getting with an M&A deal, assuming it's all cash, like exactly what your return is. It's simple. And I just think like one of the reasons we can talk about like I love investing in consumer also is because like who the strategics are. They're so clearly defined. They have a history of M&A. I think in tech, whenever we underwrite an investment, like sure, am I underwriting to like a 500 to billion-dollar exit? Sure, but do I have like a strong sense for like who would eventually acquire the business? Like not nearly as much as I do on the CPG side. So yes, I think exiting to a strategic is like the cleanest, most like secure way in CPG to generate returns. Whereas like I wish the IPO markets were more secure, but there just isn't that like level of history and traction to make me feel as confident.
So, Red Antler, which is of course one of the premier branding agencies or one of the most well-known,
I think so.
launches a $30 million debut fund, which I know you're part of and lead. Why did it make sense? Give us some context about Red Antler and why it actually made sense for them to launch a venture fund.
Yeah, 100%. So Red Antler's been around since 2007. I would define them in the least arrogant way as the lead creative agency servicing the startup ecosystem. They've been around the longest. They've generated, in my opinion, some of the best brands and companies over time. And I think what they realized a couple years in with like the success of some of their early ones was just that they were getting incredible access to entrepreneurs even before pre-seed investors. If you're branding Allbirds Pros, Hinge, Casper, Chime, Ramp, etc., and that's pre-launch for the most part, that means you're having some pretty incredible access to opportunities before any investor is really seeing them. So I think the first thing they realized pretty quickly was that their access was insanely strong and their pipeline as an agency looked more like a venture portfolio than most other agencies. So that was like insight number one. Then insight number two was like, all right, let's go test this and learn and see like if this access actually gives us a strategic advantage before we go raise a real permanent from outside LPs. And so Blake Lyon, my co-GP, as well as JB and Emily, who co-founded Red Antler, like banded together. They had a bit of extra capital on the balance sheet that they started investing into startups between like 2017 and 2020. They're one of the early investors into Ramp, the $8 billion fintech business. They're early investors in Say Beauty, Topicals, Cake, and a couple other great consumer brands. And so, like, through that experimental phase of saying, hey, we have great access. Oh, and also we have a really unique angle to bring to a cap table as being one of the only like creative experts on a cap table in most situations. Like, we think a venture strategy can really work well. And it did. The performance of that kind of balance sheet investing entity did really well. They ended up getting inbounds from great businesses that weren't even Red Antler clients. So it came to the forefront amongst the entrepreneurial community that like we were obviously getting great access through our own portfolio, but other people wanted us on their cap table just given the value that we get out as a creative agency. And so I think leveraging like the insight that they had incredible access with a very unique angle from a value add perspective on the cap table, there was enough there to feel confident and go out and raise a permanent fund. And so that's what they did. And that fund came together at the end of 2021. It began deployment at the beginning of 2022, really late 2021. And that's kind of the inception story, I would say.
And why 31 million for fund one? Why that number?
I wouldn't say so. Like, I would say a debut fund at 30 million. It's not like small. It's not enormous. Like, I'd say it's like it's a solid fund, but it's not huge. I think at that point, like they had enough success investing directly into businesses that they didn't need to go and like prove themselves to LPs with like a really small strategy. Like they had already done that off their own balance sheet. And so for them, it was like, all right, like what's a number where like we can have some true firepower? Like we can write much bigger checks than we were writing off of our balance sheet. We also have the ability, right, to like invest in a lot of businesses across both software and CPG. And that's kind of the number that felt like it's big enough to do some damage, but it's not like so big that like we don't deserve it given like this is fund one. So I wouldn't really necessarily say there was like intense logic behind the number, but it was more just the fact that we felt like we could skip like that debut mini fund because we had already executed off of like the Red Antler like investment side.
Can you talk to me a little bit about that relationship between Red Antler and Habitat and in terms of the decision making?
So we sit completely separately, like legally, completely independent entities. There's no legal relationship between the two entities. Like I do sit in the Red Antler office on a day-to-day basis, but in terms of structuring, like we do not sit under like a Red Antler holding code that has the creative side and then like the fund, like completely independent entities. Um, where there is like overlap in terms of like ties to each other, like more directly is, JB and Emily are partners in our fund. They have carried interests. They're involved relatively regularly in terms of like seeing the deals we're doing, advising our portfolio company CEOs on a weekly, monthly basis. So that is like one direct tie. And then Blake, who's my co-GP, is also head of business development and chief business officer over at Red Antler as well. So there's like human ties between the two entities. All of our capital is from outside LPs. We don't have like anchor money from Red Antler. So it's like a traditional LP base. And then in terms of like the way we work with Red Antler, so there's a couple different ways. There are deals that we do probably 40% of the time that come through the Red Antler pipeline from a sourcing perspective, right? Like that's a big part of our strategy. We believe we're seeing incredible opportunities before anyone else through Red Antler. And so they're incredible from a sourcing perspective. Number two is we can really tap into the Red Antler talent, whether that's JB or Emily, or maybe other creative strategists on the Red Antler side, when a portfolio founder comes to us with a question on brand, creative, vision, etc. So we often are setting up our portfolio company founders with talent on the Red Antler side to advise them on how they should be thinking about creative direction in the future. Third would be like business development more directly. So, Red Antler's historical client pipeline base is very rich. It goes back to 2007. If you're a B2B SaaS business in our portfolio and you happen to be selling into CPG brands, well, Red Antler has worked with hundreds of CPG brands. And so our ability to make intros to like fuel business development is very strong. And then I would say, like, also, we never push this upon our portfolio companies because we know Red Antler is relatively expensive in the agency world. But if they formally want to open up a scope of work after we invest with Red Antler, like obviously we're going to find a way to do that in a way that's like somewhat favorable in terms of terms, to the startup itself.
So let's say a company comes to Red Antler and starts working with Red Antler, and Red Antler loves this company. Oh my gosh, this is going to be the next big thing. Whether it's a consumer brand or it's a software company, they say, you know what? I think I want to pass this over to Daniel here at Habitat Partners. I want to see how does a conversation go between obviously that handoff, and then as well as, is it completely Habitat Partners' decision when it comes to investing, or is there any type of, hey, we got to do this one from the Red Antler folks?
The strategy that we feel like gives us a competitive advantage is that our pipeline and our sourcing is largely coming through Red Antler, and that gives us like a first look before a lot of investors. So if we didn't do like a solid amount of deals through the Red Antler like pipeline, we wouldn't be necessarily like executing our strategy and competitive advantage. So it wouldn't make sense. With that said, like I said, it is about a 50-50 split where I am sourcing half of our deals through traditional sourcing methods and not through Red Antler. We want to act like a traditional fund as well. But in terms of like the conversation, it is extremely independent. So I honestly have a pretty blind eye to what's happening at Red Antler on a day-to-day basis. Like, I will often get introduced to a founder by Blake, JB, or Emily after they think it's potentially exciting. And then I will do my own independent diligence process with that founder, having no history to the fact that they were like working with Red Antler until like I find out to like start the diligence process. And that's like obviously on purpose. We don't want there to be a conflict of interest. I want to have a completely unbiased like view going into a diligence process. And often, I mean, if you think about like the total Red Antler pipeline and how many of those companies we actually end up investing in, it's a very small portion. It doesn't guarantee anything. And like, obviously that's also on purpose. Like Red Antler is its own services business. It needs to grow. It needs to deliver returns, profits to shareholders. And so, yeah, it's an extremely independent introduction and process in terms of like me inheriting the conversation for the first time.
I had one investor uh, tell me, the minute you think that you have the best deal flow, and you don't need access to someone else, I'm okay, because of my network, you you've lost, you're screwed. Do you find, because you have this unique relationship with Red Antler, do you find it makes on the sourcing side like less hungry, for example, because you do have Red Antler right here at your fingertips, that they're able to have access to?
Well, anecdotally, Blake has told me to slow down on sourcing over the last few months, so I wouldn't say it has curbed my hunger. I'm pretty aggressive and always on with sourcing. And I've said this, like, we had this modern retail article the other week, and I said in the article, like, my goal is to make like Habitat Partners its own independent venture capital fund that like entrepreneurs think of irrespective of our relationship with Red Antler. Like, of course, that is a competitive advantage, and it's something that we offer to entrepreneurs in terms of our ability to be like a great creative partner. But like my personal goal is to be extremely unreliant on Red Antler as like a GP of this fund, and then of course have Red Antler in my back pocket and know that like there are going to be a couple deals like every few months that are like coming through Red Antler. But I like that like comment that you made. I feel like no matter how much time I spend sourcing independently from Red Antler, I'm always going to miss some deals. That's just the nature of like being in this industry. Try not to beat myself up over it, but I certainly find myself pretty harsh on myself sometimes because I'm a bit of a perfectionist. But yeah.
So let's get into the fund. And I'd love to have you break it down for us if that's all right. You invest in both consumer physical product businesses and as well as software businesses. Can you walk me through how you think about the return profile for each sector?
Yeah, 100%. I mean, I won't go into like our specific like numbers, but just to give you a picture, it's like how we think about the CPG portfolio strategy versus like the software portfolio strategy. Like on the CPG side, we're like seed investors, like early Series A, I would say, and like we're probably, if you think about like a pendulum of like being extremely dedicated to power law, like on the right side, and like not dedicated to power law at all on the left side. Like with CPG, we're probably somewhere in the middle. Like we do expect like a couple deals to make most of our returns, but at the same time, like the attrition rate that we expect on the CPG side in terms of percentage of bets that go to zero is like much lower than on the tech side. So if you imagine, like, to break it down in the most simple way possible, let's say we have $1 million dedicated to CPG and we have $1 million dedicated to software. Like on the CPG side, we might place 10 $100,000 bets. Given that it's like the seed stage, I usually underwrite 10 to 13x. I think, when I was focused more on Series A investing in CPG, we're often underwriting like 7 to 10x, and then like growth equity, it's more like a 2 to 4x. So like I usually underwrite 10 to 13x. Our average entry price is usually around $15 million post in like the seed early Series A phase. And so if I could get like two of those investments, let's say one exits for 13x and brings back 1.3 million, another exits for 10x and brings back a million, two of them 3x, so return 300k each, and then a fifth returns its money back, then like I've charted a pathway to $3 million, which is 3x my CPG fund. On the SaaS side, it's very different. Like it's much more of a power law play. So like let's say on the SaaS side with $1 million, I actually placed 20 bets instead of 10 bets. They're all 50k checks, so they're much smaller. I'm underwriting on the SaaS side, like hopefully an exit above 20x minimum. And I probably only expect like two of them to really hit that profile, and that's all I really need to generate my 3x. So if you imagine like a 50k check, 40xing, right? That's going to be a $2 million return. If you imagine another 50k check, 20xing, that's going to be like $1 million return. And those two combined would bring back 3 million on $1 million fund, which would also 3x our fund. So they're different pathways. I'm underwriting like big exit outcomes on the SaaS side, 500 million to $1 billion. On the CPG side, I feel like the benchmark is always 300 mil, but I'm a little more conservative, and I'm usually underwriting like 150 to 250.
Why have two different strategies? This is what and it's not just by the way there's a lot of funds that invest in kind of both of these large sectors, and when I say that two different strategies, not so much just in terms of one strategy that's very power law heavy on the tech side, and then one that maybe we can call it more evenly distributed in terms of where your returns come from. Why have two strategies? Because it's a $31 million fund. It's not small, but it's also not huge. It's 31 million. Why does it make sense to kind of underwrite and because then you have to execute both on it?
Yeah, I mean, look, I think to be a bit simple on this one, like at the end of the day, you should be investing where you think you have superior access to deal flow. I think it goes back to their conversation on Red Antler. So I think a lot of people from the outside think Red Antler services CPG companies, and they do, but their actual client base is extremely diverse. They service health tech businesses, they serve software businesses, they service robotics businesses, they service climate tech businesses. And so that like client base is not like an 80-20 split CPG software. It's actually like a very even split across technology and CPG. Like, and during COVID, for example, when like there was just less innovation because people were just really constricted on doing anything, like, Red Antler was servicing a ton of digital health companies. So because like our client base is so diverse, and because we feel like we're getting access to generational CPG and SaaS businesses on a regular basis, like it makes sense for us to be investing in both because we have access to both. I think more like macro focused, I think having access to both is kind of a hedge against risk. Like consumer spending has been notoriously pretty consistently strong over the years, even in this inflationary environment. And so like I think continuing to invest in consumer is really attractive and exciting. And I also think that like from a valuation perspective, there's never been a healthier valuation environment for branded products. You can get in right now, and from our perspective at 2 to 3x run rate. Take tech, and it's usually 3 times the multiple of CPG. So we're investing 2 to 3x run rate in CPG, like we're lucky to be getting in at a 10x ARR on the SaaS side. So you're getting into these lower entry prices. You're exposed to consumer spending, which is really strong in the United States pretty historically. But then on the tech side, like I think what's amazing is let's say our CPG portfolio completely fails and like 4 years from now we're at like a 0.5x on our CPG side, which I don't believe is going to happen, but let's just say it did. If we could hit one 100x investment on that software side, we could return our entire fund even with a 0.5x on the CPG side. And so, like, what's exciting about SaaS, besides the fact that we just have great access, is like if we flat out fail everywhere else, there is a world where we generate our 3x DPI just solely based off one bet on the software side. And so that's why it's nice, in my opinion, to also have the tech investing strategy alongside CPG.
But do you find that, let's say that you have a software company that maybe can deliver on the 100x. Do you find, because your portfolio is split and you're investing, if it's evenly split and you're investing 15.5 million on one, 15.5 million on the other, will you actually receive enough allocation when you actually invest in that company to actually for the math to actually work?
Yeah, it's a good question. So we're not evenly split. I would say for every dollar in CPG, we're investing $1.50 to $1.75 in software. We have 40 portfolio companies, 25 are SaaS, about 15 are CPG. We realized that like on the tech side, we may need to have like more pro rata to continue upping our ownership, given that there is big follow-on rounds, the valuations are higher, so we're getting less ownership up front. So we've purposely allocated a little bit more to the software side, probably a 65-35% ratio from a plan perspective, to ensure that like if one is working on the tech side, we really can like double down pretty aggressively. We have one business, for example, called Motion that just raised like a $30 million Series B, and we've invested in that business 4 separate times. And so I wouldn't say that we're able to have like as aggressive of a pro rata strategy as other funds who may be doing it like 50-50. But like we definitely have over allocated a little bit on the SaaS side compared to the CPG side, because the ownership that we're getting within the CPG side is much higher than the SaaS side, even though usually the exits are also a bit smaller as well.
But is it the same entry point, meaning the same amount of between the two on the software side, not entry point in terms of valuation. I'm sure that's, quite different to the CPG angle, but in terms of the amount, the first money in, how much you put in, is that roughly like similar on the CPG side, but you actually just have a lot more reserves on the pro rata side for software?
That's right. The last point is right. We probably average a 250K to 500K entry check on the software side, but we're placing more bets, right? I told you out of the 40, we have 25, right? Out of the 40. On the CPG side, we're placing less bets. The business typically have a little bit more traction and data to go off of when we're investing. And so our check size is often on that side more between like 400 to 750K. And yeah, that's kind of like the strategy. It's, again, we're placing a few more bets on the SaaS side. We have a little bit more left over for reserves. And on the CPG side, yeah, it's a little bit bigger of an entry check where we kind of secure our ownership up front.
Um, got it. That makes sense. And how much on both sides do you feel currently that on the sourcing side, typically it comes from Red Antler?
Yeah, I would say, we want to do a postmortem exercise after fund one where it's like, all right, where did this come from? And like, what was the outcome? And is Red Antler like outperforming non-Red Antler source deals? Like that's definitely on my plate to do once we're a little bit farther into fund one. Um, I would say my hunch is that 40% of our deals come through Red Antler. Like I do find myself sourcing usually things on the outside a little more than I do on the Red Antler side, but like I've never gone like a 6 month or like 3 month period where something hasn't come through on the Red Antler side. So I would say it's probably like 40-60, 50-50, but it also depends on kind of the state of like the venture markets in general. As you can imagine, like Red Antler is not you know, able to avoid a huge venture downturn in that like if there's less money flowing into startups, then they have less money to spend on Red Antler, right? So Red Antler's client pipeline also like fluctuates with the strengths of the venture markets as well, and they're having a great year. But like in years where venture is booming, like I'm gonna guess that my ability to source through Red Antler is stronger than in years when venture isn't as strong.
This episode is brought to you by Propeller Industries. If you run a high growth business and you're focused on profitability, extending your runway, and improving your operational efficiency, you probably need a finance and accounting whiz that will grow with you. Well, instead of hiring someone full time, what would be cost effective is working with Propeller Industries. Propeller Industries is a leading strategic finance and accounting partner for venture stage companies and has partnered with over 1,000 startups and high growth businesses across consumer products, consumer tech, and enterprise. Some of the brands that they've worked with are Liquid Death, Olipop, Hims, Farmer's Dog, Away, MoviePass, and Giphy. Propeller also provides specialized support for fundraising and M&A with transaction advisory services. Propeller's TA team of former investment bankers and investors can step in on more of a project basis when pursuing full-scale financing and M&A. There's a link to Propeller Industries in the show notes if you want to learn more information. What do good metrics look like for consumer brands in the stage that you're invested in? I know it's like, typically around like 100K checks. What traction do you like to see at that stage?
Yeah, so consumer brands were usually like 400K to 750K check. We No, it's all good. We focus like pretty heavily on like a couple things. So like A is gross margins. To me, that's the most important metric in all of CPG. We like to look at all in gross margins, so including warehousing and freight subtracted out as well. It also varies a lot per sector. So if I'm looking at a skincare business, I'm hoping to see at least 70% gross margins. If I'm looking at a food business, my hope is seeing like 40% gross margins. So I always start with gross margin, and I always find that like people rarely ever try to show me all in gross margins. Like I have to get the full P&L to really do my own math there. We look at retention rates. Like a lot of our brands are omni-channel or have some kind of D2C business. So like hopefully seeing 12-month retention rates over 30% as a benchmark. I kind of do this other exercise that I don't know a lot of investors are doing it, but like within those repeat purchasers, how many go on to repeat 3 times or more? I think like there's this, at least it's my hunch, is when you subscribe to something, you buy it once and then you typically let it come to you again a month later. And then that's where you make your decision point. Like if it's the second time you're getting something, you're kind of
It's
like
like,
in your head,
oh, I forgot I ordered this and
yeah.
it
It's like,
came and
do I
then
really
yeah.
like this or do I not? Like that second time. And so I think just like sometimes repeat numbers get kind of overstated if you only just consider repeat as a whole, because there's so many that churn after the second order. And so what I like to do is I like to look at like how many buying 3 times, 4 times, 5 times, 6 times, and so on, and like what percent of repeat purchases fall into that versus just like 2 times repeat. Um, I look at first order profitability. Like, I don't think D2C is dead, but if like you can't generate first order profitability with like the unit economics and CAC associated with your D2C business, it is a really tough environment. So that's something we also look for. Like retail, we look at velocity data. We do like to see like businesses going head to head with like the incumbent competitor at like at least 50 to 75% of the unit per store per week that the category incumbent is achieving. And then the last thing is just cash flow from operations. I don't have a specific number, but essentially, like I like businesses that kind of come to me in a position of power where like they're not burning so much that like they have extensive runway. Where even if I didn't invest, like the company is going to be a going concern for at least 12 months. The worst thing that could like happen to me as an investor is I send out my Q and update to my LPs about how excited I am to invest in this new business, and then by Q3 or Q4, I'm writing to my LPs saying the business went under. And so I'm always like hyper cautious on not funding businesses that are like about to run out of money. I like to like go to businesses that are like in a stable place, don't actually need my money necessarily, but see the value of partnering.
I've heard that that the best businesses typically are that you should invest in are the ones that actually don't need your money.
That's right.
Then if you're not in the position of power and the business is in the position of power, how what's your negotiation strategy in order to get allocation or even to get on their equity table when they actually we actually maybe don't need your money, or maybe it's a really hot deal, maybe they do need money, but you obviously want them to go with you all.
Well, I'll first and foremost, I'll just say I think I have found that CPG in general is slightly less competitive than software. Like almost every software we do feels competitive. Like it just feels like there's hundreds and hundreds of firms that could like theoretically invest in this business. And so like I feel like we're always fighting on the software side. Whereas like CPG side, like sure, sometimes there's elbows, but at the same time, I feel like it's like one of the most collaborative groups of investors like I could ever imagine. Um, so the reason why I was really excited about joining Habitat Partners was because of this creative angle. I wholeheartedly believe that there are very few like institutional investors or private equity investors that actually understand world-class creative. And I think what's exciting right now is like obviously in CPG creative is extremely important, but I think now even in the B2B SaaS world, like the importance of creative and content is coming to the forefront. And a lot of B2B founders are starting to like behave kind of like B2C businesses. They're creating short form content all the time and posting on like different platforms. They're publishing case studies and blasting it out on LinkedIn with like a long thing as to like why they're an effective business. Like there's just a lot of I would say B2Cification of B2B SaaS. And so I think all of a sudden like B2B SaaS businesses really value having someone that has a creative mind on their cap table to like bring together the entire syndicate. And so I mean, our pitch is kind of that. Like, we can be that creative mind. We are experts in UI and UX, and we are experts in branding, and that is really important for B2B businesses. And like thinking back to one of our best investments before we launched the fund, which is Ramp. Like, I believe that part of the reason why Ramp is so successful is because it has tremendous design, it has tremendous user experience. It's very easy, it's sleek, it looks good in your wallet, and Red Antler did all that work. And so, like, I'm bullish on our ability to add unique value as creatives within both CPG businesses and software businesses, and that's a big part of our pitch.
Yeah, I mean, marketing to SMBs, which I think a lot of, B2B businesses, that is their core target market. It looks a lot more. I mean, obviously there's like, product like growth, which obviously ties into that. But from that from like, but SMBs might look a bit more like you're almost targeting a consumer as opposed to these very, very long sales cycles that are kind of come with enterprise SaaS.
That's it couldn't be more true. I will say, like, we do enterprise SaaS also, so like we are trying to like hit enterprise as well. We've done a couple enterprise SaaS deals this year, but for the ones that like are selling into CPGs, like B2B SaaS businesses, we can obviously be incredible biz dev partners. Like my goal is to always fuel more ARR than our check size. And then on the enterprise SaaS side, a lot of times we're investing in marketing tech. We come from an agency. We have a really good feel for like why marketing tech might work or not work. And so I think we can be really, really valuable partners in marketing tech, especially in the enterprise SaaS environment as well.
Because I know that your entry point to food and bev or venture was through health and wellness, has it been difficult to also, manage a portfolio when it comes to B2B SaaS or on the software side? Because that wasn't maybe like the initial, your initial reason why you wanted to go into venture?
Really good question. So I'll just say this, and I feel like it's sometimes a controversial topic, like go get an MBA or don't get an MBA, they're stupid. I take no offense to people who think MBAs are stupid. It's truly like it's fine. I think there's great things about them and stupid things about them. For me, like my reason for going to Stanford for MBA was because like I wanted to inundate myself in like the software ecosystem, and I didn't think there was like a better school to like do that at. And so when I spent 2 years in Silicon Valley, I was networking a ton with like tech VCs. I was taking classes on how to scale SaaS organizations. I took classes on product market fit. So like I kind of felt like I got a 2 year like really strong education on like SaaS and really like kind of like ate the soup there. And so coming out of B school, I already felt like I could be like somewhat dangerous with a SaaS business. And especially because most of the SaaS businesses we're investing in are tied to brands in some way. It hasn't been like that hard of a transition. And I think from a diligence perspective, right? Like there's a lot of overlap in the metrics like MRR growth, burn ratio, net revenue retention, customer churn and retention, customer concentration. Like those are a few of the things we're looking at on the SaaS side. And they're not like that complex. I think if I was going to go be like a PE tech investor, that might be like a bit of a stretch for me. But like doing early stage tech where there's usually less than a million in ARR, like the diligence from a quantitative perspective is pretty like straightforward. And at the end of the day, it ends up being more about access, the founder, and the idea, anyways. So it honestly hasn't been that deep of a or steep of a transition, in all honesty.
Well, I know that you remarked earlier, which is kind of what gets thrown around in the ecosystem, that D2C is dead and all that, which I totally agree with you. It's not dead. It's just a sales channel, and that's been kind of covered repeatedly on this podcast, and as well as a lot of other places by people who are way smarter than me. But is SaaS dead? Because I've also heard this kind of remark kind of coming around. I know that you invest in SaaS, so maybe it's not dead. But the idea that you can actually build a large SaaS company that where you actually do have real moats, is that a thing of the past?
God, it's a good question. Look, I think I don't want to use the word AI like 100 times in this response, but
Well, you haven't used AI yet, so you
I know
can.
I went the
Yeah,
entire
yeah.
podcast
We went
without.
we went 38 minutes without talking about AI. This is amazing.
I know consumer brands are so boring. Like, what the hell? No, what I'll say is I feel like if you are not embedding like AI infrastructure like into your software business in order to make like at least the product experience optimized, the ability to like acquire customer optimized, like I'm not saying that like you can't build a pure SaaS business in the future, but I think businesses that like don't embrace AI on top of their core SaaS business are going to be left behind. And like to give an example of like a business that like I think has evolved to embrace AI really well. There have been a ton of tools for financial planning and analysis, SaaS tools that have like had success over the last 10 years servicing brands. And we invested in this business called Zenlytic that just raised a Series A from M13. Um, Zenlytic is an FP&A tool, but it has this entire AI infrastructure layer where essentially like you can type in a prompt, hey, show me my best performing ROAS marketing channels over the last 6 months. It's automatically API'd already into like all of your data systems. And it uses this like AI agent to then create that like visual business analytics answer to your question. And so like that's the new way, in my opinion, of doing FP&A, and it involves AI. But I wouldn't like classify Zenlytic as like an AI machine learning model company, right? It's like an FP&A tool that has an AI infrastructure layer. And so I think like looking into the future, I do think it's going to be really hard to build those kind of SaaS tools without having some kind of like focus on AI as like an enabler. So again, I don't think SaaS is dead. I think SaaS that is ignorant to how AI can supercharge the core product is probably going to be dead or not able to scale.
So when you invest in a software company, does it have to have an AI component?
It doesn't have to, but I haven't really come across a lot lately that like isn't in some way embedding AI into like the development process, the product, the acquisition process, the customer experience. Like it's just hard to find it these days because if you're not like using it, you're probably being less efficient than you can be. And I feel like the quality of founders we're talking to are just like it's an obvious thing for them to be thinking about when they're building their product.
Well, I mean, I would say, would you invest in a company that was a software company that had no AI capabilities?
Yeah, I mean, I don't feel like we've like thinking of our last four investments, like they all have had on the SaaS side some kind of AI component. But I'm not saying we wouldn't. I just haven't really like seen any lately. Truthfully, like I don't think I've seen a SaaS business that isn't embedding AI in some way that we've looked at like seriously. I think the word AI gets stretched. Like we will not invest in foundational like machine learning model businesses. Like we do not like they're too capital intensive. Our check size is too small. The valuations are too high. We don't understand how to diligence them. But like it's just hard these days to imagine like someone not at least embedding AI somewhere into their infrastructure in terms of like their process of building a SaaS tool. So like we would, I just haven't really like seen it lately, to be totally honest.
When you shifting gears a little bit, do you care more when you talk to founders and you mean founders, you mean teams, early teams? Do you care? Do you care more about how exceptional and off the charts the founder CEO is? Maybe they just completely blow you away, or do you care more about the overall founding team and how special they might be?
Yeah, I mean, I would say um, most businesses that we come into on the tech side, which are pre-seed or seed, like have barely built a founding team. Like it's usually two of them max. It's usually a CTO and a founder. And so like we usually have deep conversations with both of those stakeholders, but like I haven't really been in that many situations where like it's a 5-person team already. Like typically that's when you're at least like a million in ARR, at least from my experience. So I would say like I just haven't really been exposed to that many huge teams during a diligence process quite yet.
Is there a revenue threshold when it comes to product market fit, or how do you even think about product market fit?
It's a great question. I took a class on this, and I also have anecdotal thoughts on it. like the most important metric for product market fit is organic virality by far, in my opinion. Um, and what starts to happen when organic virality is really taking place is as you scale, instead of it becoming marginally more difficult to acquire your next user or customer or business, it becomes easier. So as you scale, CAC inherently starts to go down. Um, so for me, like I'm always looking for signs of that in like the early days. Like, is there something that's working here where like customer acquisition seems to become easier over time? I think in like CPG, like typically if you think about a subscription business, like once you've tapped out of a core audience that might love your product, like acquiring that nth next customer becomes really hard. But certain businesses have such strong organic virality and network effects and word of mouth and reviews that like they're able to over time scale their CAC way down. And so that's kind of like organic virality to me. If there's signs of it, is like the biggest kind of signifier that there's potential for product market fit.
In terms of your allocation, do you also end up leading rounds or and sit on boards or not so much?
Not so much. Hopefully for fun too, if we're able to sexually raise it in the future, we'll do more board seats. Right now, we typically do not lead. There are a few situations where we brand a business on the Red Antler side. Because of access, we end up being the only institutional capital into the business in the pre-seed. So you would call that, I guess, leading because we are kind of deciding with the founder on like the cap on a safe. But we're not like leading price rounds, and yeah, it's just not really set up to do that quite yet.
And what's and you might have already mentioned this, but of the two, I guess, sectors in the fund, what are kind of the goals in terms of once all the capital is deployed in terms of number of companies that you're in?
Yeah, I think we've probably got 10 more left. We're at 40. So I think we'll probably hit 50.
I'm gonna try something new, Daniel. I've never done this before, but we're gonna do a lightning round if that's
Let's
okay.
do it. Let's
This is
do
gonna
it.
be a quick round where I ask you a question or a comment, and you say the first thing that comes to mind.
All right.
What is the biggest consumer trend to watch this year?
Hmm. God, you can't not say like weight loss with GLP-1s. I'll say protein consumption and weight loss as like they're kind of connected um, together.
What consumer trend are you most bearish on, or you don't believe in,
Hmm. Um,
or maybe that you think it's a fad?
I think supplements are overrated, truthfully. From a venture perspective, like I just very quickly will say I think there's going to be a lot of like challenges from an exit perspective with supplements. I won't go into why, but I am bearish on supplements compared to most investors who love to see 80% gross margins and hyper growth. But overall, I think there's a lot of issues with them.
If you weren't a venture capital, what would you be doing?
I would be trying to become a professional tennis player and definitely failing.
No, you would not be failing. Not be failing. Your favorite consumer product innovation in the last 5 years?
Wow. Oh, I don't want to pick like like a portfolio company. I'll pick an angel investment because that's like less political. um, midday squares is like my go-to. I've had cookie dough in my fridge forever. I love the way they're approaching content, building the business for the long haul, and yeah, they're some of my favorite people. So midday squares.
With adventure, what's the biggest thing you've changed your mind about?
Yeah, I mean, I think when I stepped in, I thought it was like all about founder and product. And I was like, all right, if there's a great founder and this product is amazing, whether it's like a sticky software business or a great tasting chocolate bar, I kind of thought like that was enough, assuming all the other stuff on like the quantitative diligence like lines up. What I've realized over time is that go to market is the most like if not like the most important thing when it comes to like having successful startup scale. I think if you look at like Facebook, Meta, Google, and like the power they have over so many consumers in their in their user base, when they roll out new products, they tend to be like very successful because they can really skip the challenge of going to 0-1 on go to market, right? Like they can get in front of millions of consumers super quickly. They have huge marketing budgets to like push go to market. And so I think the hardest thing for a founder is just like go to market and kind of like executing go to market to get from 0-1 and then 1 to 10. And so I try to really like find ways when I'm like diligencing businesses and founders to understand like why they have a unique go to market that's going to like work compared to like other competitive products in the space. So I think I overlooked like the importance of go to market when I was first starting venture, and I think it's extremely important.
What's the biggest myth about venture capital?
You know what? This is a little dark and pessimistic, but I think like when I was first investing, I was purely focused on CPG, right? And I met all these great people, and I was just kind of like, oh, like this, everyone is so kind, and everyone wants to do deals together, and it's like green and collaborative. And now that I'm doing a lot of software on top of CPG, like I wouldn't just say that like that's the case. I feel like it is extremely competitive. Not everyone is collaborative. Not everyone is like sharing deals with each other. I try to be as collaborative as possible, but I think like I was under the belief that like everyone wanted to co-invest together based off my experience with CPG. And like within like, a year of investing in software, I found out the dynamics are just a little bit different. So I wouldn't say that venture is always collaborative. I think that is a myth. Unfortunately, I wish it was more collaborative.
I certainly agree that there is a difference between invest in CPG or consumer brands, that ecosystem for software.
Yeah.
Not that there aren't amazing software investors, and of course, many of them have come on the show.
Yeah.
Just quick
No,
plug,
totally.
but yeah, that makes it. Yeah, that's a good point. Breaking down like the different kind of qualities of what makes a great venture capitalist. You obviously there's obviously sourcing companies, there's picking the right companies, there's getting internal approval to invest in a company, there's negotiating a term sheet, there's also of course advising, working with portfolio companies. What do you think you're best at, and what do you think that they need to work on the most?
Yeah, I think like on the diligence side and like reading people, like I'm pretty strong. Weirdly, like I was a psychology major in college, and I just like I feel like I can very like quickly within one conversation, like if there's I can get like this one sense if there's like an irk from a founder, like very easily. And I'll immediately pass. So I feel like I'm good at reading people. I'm generally by like textbook standards good at diligence. I think I have like operational skills that I took from me from like CPG that add value. But like I would love to have like a wider aperture of value add skill sets that I can bring to any founder that I partner with. Like I have no technical experience in engineering from a software side. So like when it comes to product, like my ability to help a software business is very limited. Like I'm all about go to market. I would love to be a better resource for like thinking about product. Obviously, I can be a user of the product and give like anecdotal feedback, but I feel like I'm a little limited there. And then like on the CPG side, I was thinking about this the other day. Like I used to build within big CPG, I would build the presentations that they were bringing to the buyers, the retail buyers, but I was never actually selling to the buyers, and so I never developed like relationships with like the head Kroger buyer, the head Whole Foods buyer, and so I would love to, as a skill set development area, build more relationships in traditional retail. So when I can, comes time to help my founders get into retail, I have more ability to put them in front of the right people. So I think it's just incremental skill sets that I can use to add value to my portfolio companies that I just haven't quite, captured yet.
What's one book that's inspired you professionally and one book that's inspired you personally?
It's a great question. I remember you always ask this, and I love it. So personally, I mean, this is funny. I read this book in high school, but I'm such a psychology nerd. Outliers, Malcolm Gladwell. He has a bunch of really great books that like kind of go into psychology. David and Goliath, Tipping Point. Love Malcolm Gladwell. It kind of taught me that like at the end of the day, grit outweighs talent, and if you put enough hours into like perfecting your craft, it doesn't matter if you like lack the initial talent. You can often achieve kind of what you want to achieve. And my last one is Secrets of Sand Hill Road. Like I didn't when I knew nothing about venture. This was the first book I read. Thought it was really like simple but like powerful. And I ended up when I got to Stanford taking a class taught by Scott Cooper, which was pretty cool, like full circle moment. So yeah, that would be the book professionally that I really enjoyed.
I appreciate that. Thank you so much, Daniel. This has been so great. Have you on the show. Thanks again for your time.
So fun. Really appreciate the time, and look forward to seeing you in LA in the future.
And there you have it. It was great having Daniel on the podcast. Daniel, thanks again so much for coming on the show. And special thanks to Propeller Industries for sponsoring this episode. If you're enjoying the show, check out theconsumervc.com and click subscribe to be in the know of all the fundraising and venture capital news, and as well as being the first to know when we actually have a new episode. Sincerely, thank you so much for listening.